Here is what it actually takes to become a landlord in Canada. A down payment, typically 20% or more on an investment property, often in the hundreds of thousands of dollars. A mortgage application specifically for a rental property, frequently carrying stricter qualifying requirements than a primary residence. Ongoing responsibility for tenant screening, lease agreements, rent collection, maintenance calls at inconvenient hours, and the very real risk of vacancy periods where the property generates no income while the mortgage payment remains due regardless. Property management fees, if you choose not to handle these responsibilities yourself, typically 8% to 12% of monthly rent. And concentrated risk in a single property, in a single neighborhood, in a single city. Here is the alternative this video covers: opening a brokerage app, searching a specific ticker, and buying shares of a real estate investment trust, a REIT, in approximately 90 seconds for as little as the price of a single share, gaining proportional ownership in a professionally managed portfolio of dozens or hundreds of real income-producing properties, with monthly or quarterly cash distributions paid directly into your account, no tenant ever contacting you directly, and the ability to sell your stake within seconds on any day the market is open. Something a physical rental property, by its very nature, can never offer. This video explains exactly how REITs work, the one specific legal rule that forces them to behave fundamentally differently from a normal company and directly produces the income stream that makes them attractive. The specific property sectors a Canadian REIT ETF like VRE actually holds, how their distributions are taxed, and, honestly, what you give up by choosing this path over direct property ownership. A real estate investment trust is a company, or more precisely in many structures, a trust, that owns, operates, or finances income-producing real estate, and whose shares, or units, trade on a public stock exchange, allowing investors to buy and sell ownership stakes just as they would with any publicly traded stock. REITs were specifically created, originally in the United States in 1960 and later adopted in Canada and many other countries, with a particular legislative purpose: to allow ordinary individual investors to access the income and potential appreciation of large-scale, professionally managed commercial and residential real estate. Apartment buildings, shopping centers, office towers, industrial warehouses, and similar properties, without requiring the enormous capital and direct operational involvement that purchasing such properties directly would otherwise demand. Here is the vault from the opening, the legal rule that produces the income. To qualify for REIT tax status in most jurisdictions, including Canada's framework for REITs, an entity must distribute a very high percentage, commonly required to be at least 90%, of its taxable income directly to shareholders as distributions on a recurring basis, typically monthly or quarterly, in exchange for receiving favorable tax treatment at the entity level. This single legal requirement is the entire mechanism behind why REITs, as a category, are known for producing reliable, regular cash distributions in a way that a typical growth-oriented company, which retains most or all of its profit to reinvest in expansion, simply does not. A REIT is not choosing to be generous with distributions out of some unusual corporate culture. It is, in a very real sense, legally and structurally required to pass the overwhelming majority of its rental income through to shareholders as a condition of qualifying for the tax treatment that makes the REIT structure viable in the first place. Why this distribution requirement exists from a policy perspective. The underlying rationale, broadly consistent across the jurisdictions that have adopted similar REIT frameworks, is that a REIT functions primarily as a pass-through investment vehicle for real estate income, rather than as an operating business retaining earnings for growth in the way a typical corporation does. and tax authorities in exchange for allowing REITs to avoid corporate-level taxation on the income they distribute, which would otherwise create a double taxation problem, similar to the dividend gross-up concept covered in this channel's other videos, require this very high distribution rate to ensure the structure is genuinely functioning as intended, as a conduit delivering real estate income to individual investors, not as a vehicle for indefinitely retaining and compounding earnings within the entity itself. Why this matters practically for understanding what a REIT investment actually is. Because of this structural requirement, REITs as a category have historically retained comparatively little capital for reinvestment relative to a typical growth company, meaning their growth, beyond the underlying appreciation of the real estate itself, frequently relies more heavily on issuing new shares or taking on additional debt to fund acquisitions than on retained earnings, a structural characteristic that distinguishes REIT investing from growth stock investing in a way every REIT investor should understand explicitly, covered further in Segment 3. Your action step. The next time you see a REIT advertising an attractive monthly or quarterly distribution yield, recognize that this is not primarily a sign of unusual corporate generosity or quality. It is a structural, legally mandated consequence of how REITs must operate to maintain their favorable tax status. Rather than purchasing shares in a single individual REIT, which would concentrate your investment in whatever specific properties and sectors that one company happens to own, most Canadian investors seeking broad real estate exposure use a REIT-focused ETF, such as VRE, the Vanguard FTSE Canadian Capped REIT Index ETF, which holds a diversified basket of Canadian REITs across multiple property sectors in a single purchase. The major property sectors typically represented in a diversified Canadian REIT ETF. Residential REITs own and operate apartment buildings and multifamily rental properties across Canadian cities, generating income from monthly tenant rent payments across potentially thousands of individual rental units spread across many buildings and multiple cities, dramatically reducing the single tenant or single building vacancy risk that a direct landlord with one or a handful of properties would face directly. Retail REITs own shopping centers, malls, and retail plazas, generating income from lease payments by retail tenants, grocery stores, big-box retailers, smaller specialty shops, with income tied to lease terms that are frequently longer duration than residential leases, providing a different risk and income profile. Industrial REITs own warehouses, distribution centers, and logistics facilities, a sector that has historically benefited from the structural growth of e-commerce and the associated need for warehousing and distribution infrastructure, generating income from long-term leases to logistics, retail, and manufacturing tenants. Office REITs own commercial office buildings, generating income from lease payments by corporate tenants, a sector whose demand characteristics have been a subject of ongoing discussion in commercial real estate following broader shifts in remote and hybrid work arrangements that began during the COVID-19 pandemic, with implications that continue to evolve and are genuinely uncertain in their long-run effect on this specific sector. Diversified and specialty REITs own a mixed portfolio across multiple property types, or specialize in specific niches such as healthcare facilities, self-storage, or data centers, providing additional diversification within the broader REIT category itself. Why this sector diversification matters specifically. A single rental property, purchased directly, exposes the owner entirely to the specific dynamics of one property type, in one neighborhood, in one city, meaning a downturn specific to that property type or that local market, a major employer leaving a city, oversupply of new construction in that specific neighborhood, A shift in tenant preferences for that property type directly and disproportionately affects the entire investment. A diversified REIT ETF spreads this same underlying exposure to real estate income across multiple property types, multiple cities, and dozens or hundreds of individual properties and tenants simultaneously, meaning no single property, tenant, or local market dynamic can meaningfully threaten the overall investment in the way it directly threatens a concentrated, individually owned rental property. The cost and access. A Canadian REIT ETF, like VRE, typically carries a modest annual management expense ratio. Verify the current specific rate, as this is periodically adjusted, trades on the Toronto Stock Exchange in Canadian dollars, and can be purchased through any major Canadian discount brokerage with no minimum investment beyond the price of a single share. A dramatically lower barrier to entry than the down payment required for direct property ownership. Your action step. Look up the current sector breakdown of a Canadian REIT ETF like VRE on its provider's fact sheet, and compare that diversification explicitly against the single property, single sector concentration that direct rental property ownership would otherwise require for an equivalent dollar investment. REITs, as a category, have a well-documented structural sensitivity to interest rate movements, a relationship every REIT investor should understand explicitly because it directly affects how this specific asset class tends to perform in different economic environments. The mechanism behind this sensitivity. This sensitivity operates through two distinct channels. Channel 1. REITs typically carry meaningful debt to finance property acquisitions, and that debt's cost is directly affected by prevailing interest rates. Because of the limited retained earnings available for growth covered in Segment 1, a direct consequence of the 90% distribution requirement, REITs frequently rely on borrowed capital to fund property acquisitions and portfolio growth. When interest rates rise, the cost of this borrowed capital rises correspondingly, directly compressing the profit margin between a property's rental income and the cost of financing it, which can reduce the funds available for distribution to shareholders or constrain the pace of future acquisitions and growth. Channel 2. REITs are frequently valued, in part, by comparing their distribution yield against the yield available from comparatively lower-risk fixed-income alternatives, such as government bonds. When government bond yields rise, the relative attractiveness of a REIT's distribution yield for income-focused investors specifically diminishes somewhat in comparison, which can place downward pressure on REIT valuations and share prices, independent of how the underlying real estate properties themselves are actually performing operationally, meaning a REIT's share price can decline due to broader interest rate movements even while its underlying properties continue generating stable or growing rental income. Why this is important to understand clearly. This means REIT share prices, particularly over shorter time periods, can be more closely correlated with movements in prevailing interest rates than with the underlying operational performance of the actual real estate the REIT owns. An important distinction for any investor who assumes a REIT's share price should track real estate market conditions in their local area in a simple, direct way. The historical pattern this has produced. During periods of significant interest rate increases, such as the rate hike cycle implemented by the Bank of Canada in 2022 and 2023 in response to elevated inflation, REIT sector valuations across many markets experienced meaningful price declines, even in cases where the underlying properties continued to maintain stable occupancy and rental income, illustrating Channel 2 above in a real, recent historical example. Conversely, when the Bank of Canada and other central banks have cut interest rates, REIT valuations have, at various points, benefited from this same mechanism operating in the opposite direction. What this means practically for a REIT investor. A REIT investment should generally be understood and evaluated, at least in part, through the lens of prevailing and expected future interest rate conditions, in addition to evaluating the specific quality, occupancy, and growth prospects of the underlying real estate portfolio itself. A more nuanced framework than treating a REIT purely as a direct proxy for Canadian real estate, because its publicly traded share price incorporates this additional interest rate sensitivity layer that a privately held, directly owned rental property's value does not experience in the same immediate, continuously repriced way. Your action step. Before evaluating any REIT investment's recent price performance, explicitly check what prevailing interest rates were doing over that same period, to distinguish how much of any price movement reflects genuine changes in the underlying real estate's performance versus broader interest rate sensitivity affecting REIT valuations across the sector as a whole. How REIT distributions are taxed for Canadian investors. REIT distributions are frequently composed of multiple distinct components, which can include a portion treated as regular income, taxed at your full marginal rate, a portion that may be treated as a return of capital, which reduces your adjusted cost base rather than being immediately taxed, deferring the tax liability until the investment is eventually sold, and in some structures, a portion that may qualify for more favorable capital gains tax treatment. The specific composition varies by REIT and by year, and is typically disclosed on the T3 tax slip issued to investors annually. Meaning, unlike the relatively standardized eligible dividend tax credit mechanism covered in this channel's dedicated dividend taxation video, REIT distribution tax treatment requires checking the specific breakdown provided each year rather than assuming a single consistent tax rate applies. The TFSA and RRSP consideration, holding a Canadian-listed REIT ETF like VRE inside a TFSA, shelters all of these distribution components from tax entirely, regardless of their specific composition in any given year, making the TFSA frequently the most straightforward, tax-efficient account in which to hold this specific asset class for a Canadian investor. Avoiding the need to track and understand the varying tax treatment of each distribution component that would otherwise apply in a non-registered account. Now, the honest comparison: what you genuinely give up by choosing REITs over direct property ownership. You give up the ability to use significant leverage in the way direct property ownership allows. A direct property purchase with a 20% down payment provides exposure to 100% of that property's price appreciation using borrowed capital for the remaining 80%. A form of leverage that, when real estate prices rise, can produce a meaningfully amplified return on the investor's actual invested capital compared to purchasing REIT shares with cash, which provides no equivalent leverage mechanism. An investor could, in principle, borrow money to purchase REIT shares, but this is a meaningfully different, generally higher-risk strategy than a conventional residential mortgage, and not something this video recommends without significant additional consideration. You give up direct operational control. A direct property owner can personally choose tenants, set rent levels within legal limits, decide on specific renovations or improvements, and make direct operational decisions about their specific property. A REIT investor has no input into any specific operational decision made by the REIT's professional management team across its broader portfolio. You may give up certain specific tax advantages available to direct property owners in some circumstances, such as the principal residence exemption, which applies to a primary residence, not an investment property or a REIT holding, but is sometimes confused in casual rent versus buy versus REIT conversations, and certain expense deductions available to direct rental property owners for specific costs associated with operating that property directly, which do not have an equivalent at the individual investor level when holding REIT shares instead. What you gain, in direct contrast: complete elimination of tenant management, maintenance calls, and the operational responsibilities covered in the hook. Instant diversification across dozens or hundreds of properties and tenants, dramatically reducing concentration risk relative to a single directly owned property. Complete liquidity, with the ability to buy or sell your position within seconds on any market trading day. A dramatically lower capital requirement to begin investing, with no minimum beyond the price of a single share. And the ability to invest within a tax-advantaged account, like a TFSA, sheltering the income entirely, which is not available to a directly owned investment property held outside of registered structures. The honest conclusion: REITs are not simply a smaller, more convenient version of direct property ownership. They are a genuinely different investment vehicle, with their own distinct risk and return characteristics, notably the interest rate sensitivity covered in Segment 3, that happens to provide exposure to the same underlying asset class, income-producing real estate, through a fundamentally different structure, with a different, and for most individual investors, considerably more accessible, set of trade-offs. Your action step: before deciding between REIT investing and direct property ownership, explicitly weigh your own specific priorities: leverage and direct control versus liquidity and diversification, against the honest list of trade-offs covered in this segment, rather than assuming either path is automatically superior. Let's come back to where we started. A down payment in the hundreds of thousands, a mortgage specifically for an investment property, tenant management, maintenance calls, vacancy risk, and concentrated exposure to a single property in a single city on one side. A 90-second purchase of a diversified REIT ETF like VRE, providing proportional ownership in dozens of professionally managed properties across multiple sectors, with regular distributions and the ability to sell within seconds, on the other. You now understand exactly why REITs are legally structured to produce that reliable distribution stream. The requirement to distribute at least 90% of taxable income, a legal condition for the favorable tax treatment that makes the entire structure viable. You understand the specific property sectors a diversified Canadian REIT ETF actually holds, from residential apartments to industrial warehouses to retail centers. You understand the genuine structural sensitivity REITs carry to interest rate movements, through both their reliance on borrowed capital and their valuation relative to bond yields. A relationship that means a REIT's share price is not always a simple, direct proxy for the health of the underlying real estate it owns. And you have the honest, complete comparison. REITs give up the leverage and direct control that come with a mortgage and a deed in your own name, in exchange for liquidity, instant diversification, a dramatically lower capital requirement, and the ability to shelter the entire income stream inside a TFSA. Neither path is universally correct, but for a Canadian investor who wants exposure to real estate income without becoming a landlord, without the tenant calls, the vacancy risk, and the concentrated exposure to a single property, a diversified REIT ETF is a structurally sound, accessible, and genuinely passive way to participate in exactly that asset class.